payout ratio versus shareholders' wealth. The subject matter of dividend policy chapter is whether payout ratio has any impact on the market price of the share or not. The subject matter of dividend policy is whether payout ratio has any impact on the market price of the share or not. Suppose a company is following a payout ratio of 25%. It moves to payout ratio of 40%. Whether this decision will have any impact on the market price of the share or not. In other words, if we change the payout ratio, whether the market price of the share will change. If yes, in which direction or not. Suppose we increase the payout ratio. Will the market price increase? Will the market price decrease? Will the market price remain constant? Let's revise. There is a controversy among us, the economists, that whether payout ratio has any impact on the shareholders' wealth or not. That can we increase the wealth of the shareholders simply by twisting the payout ratio. So the subject matter of the dividend policy is whether payout ratio has any impact on the market price of the share or not. In other words, if we change payout ratio, whether the market price of the share will change or not, and if yes, in which direction. For example, if we increase the payout ratio, whether the market price per share will increase or decrease, or there will be no change. There are two theories of dividend policy. There are two theories regarding this. One was suggested by MM in 1961 and says the dividends are irrelevant and the amount paid as dividend do not affect price of the shares of the company in long run. MM have considered long run. But their critics say in long run all of us will die. So, there are two theories in this regard, that is whether change in payout ratio will have any impact on the market price of the share or not. But friends, let me make it clear. By market price of the share we mean wealth of the shareholder. Whether change in payout ratio will have any impact on the wealth of the shareholder or not. In this connection, there are two views. One was suggested by MM in 1961 and says that dividends are irrelevant and amounts paid as dividend do not affect price of shares of the company in long run. The other theory asserts that dividends are relevant and they affect the share prices. Irrelevance theory. MM have opined that the price of equity shares of a firm depends solely on its earning power and is not influenced by the manner in which its earnings are split between dividends and retained earning. According to MM, the price of equity shares of a firm depends solely on its earning power and is not influenced by the manner in which the earnings are split between dividend and retained earning. They observed that under the conditions of perfect capital markets, rational investors, absence of tax discrimination between dividend income and capital appreciation, given the firm's investment policy, its dividend policy may have no influence on the market price of the shares. According to market price of the share is not affected by payout ratio. Whether your payout ratio is liberal, your payout ratio is restricted, your payout ratio is higher, lower, 0, 100%. Your payout ratio will have no influence on the market price of the share. Your payout ratio will have no influence on the market price of the share if 4 conditions are satisfied. Have given 4 conditions. According to if 4 conditions are satisfied, payout ratio will have no impact on the market price of the share. First is perfect competition. Assume that there is perfect competition in the capital market. Friends, we know that perfect competition is a market situation in which a large number of buyers and sellers are there. Commodity to be traded in the market is homogeneous. An individual operator is price taker and not price maker. Perhaps the most important characteristics of perfect competition is that in case of perfect competition, we can have only normal profit, we cannot have abnormal profit. Have made use of this characteristics of perfect competition in their theory. Number 2, the market is controlled by rational investors, not speculators. Market is controlled or influenced by rational investors. There is no discrimination in tax liability whether you have dividend income or capital appreciation. And given investment policy, your payout ratio will have no effect on the market price of the share. So have made 4 assumptions. Number 1, they assume that in the market perfect competition is there, so only normal profit can be earned. Number 2, market is controlled by rational investor. There are 4 characteristics of a rational investor. Number 1, a rational investor is guided by fundamentals. He or she is not guided by rumors. A rational investor knows the size of his pocket. A rational investor knows the size of his pocket. That is, a rational investor in advance decides what amount he or she has to invest. A rational investor knows his risk-bearing capacity. He defines his risk-bearing capacity. That is, maximum amount of loss that he or she is ready to bear. And 4th, a rational investor does not have any emotional attachment with investment. Suppose he or she has made an investment After making the investment, he or she finds that it is a wrong investment. He or she will be out immediately. It won't wait. So a rational investor is guided by fundamentals, knows his pocket, that is amount to be invested in the market, knows his risk bearing capacity, that is limits the amount of loss, and fourth, no emotional attachment. If any wrong decision is there, he or she immediately rectifies it. So according to if perfect competition is there, market is controlled by rational investor, there is no discrimination between income tax on dividend and capital appreciation. One investor has capital appreciation of 10,000, other has dividend of 10,000, both have to pay same income tax. This is the assumption of And the fourth and last assumption is given investment policy. By given investment policy, we mean that firms are always in need of funds. They are always ready to raise the funds. They need funds for expansion, modernization, replacement, etc., etc. So, according to if four conditions are satisfied, these are four assumptions of and these are also four limitations of First assumption, perfect competition. Second, rational investor. Third, no tax discrimination between dividend income and capital gain. And fourth, given investment policy. If these four conditions are satisfied, according to payout ratio will have no impact on the market price of the share. By market price of the share, we mean come dividend market price of the share. Or we can say by market price of the share, we mean wealth of the shareholder. Given these four conditions, payout ratio will have no impact on the market price of the share. Whether your payout ratio is liberal or your payout ratio is restricted, it won't influence the market price of the share or it won't influence the wealth of the shareholder. Friends, we have discussed four assumptions of These are also four limitations of Sometimes we are asked a question, what are the limitations of Number one, assume perfect competition, and perfect competition is not found in the practical life. Assume that market is controlled by rational investor, and all of us know that market is controlled by speculators. Assume that there is no tax discrimination between dividend income and capital appreciation, and we know that there is tax discrimination. Generally, capital gain is taxed at lower rate. Assume that firms are always in need of funds. In practical life, this may not be true. Firms do not require funds during recession. So, the four assumptions of are also the four limitations of According to them, market price of the share in the beginning of the year is equal to present value of sum of dividend at the end of the year and market price of the share at the end of the year. Now suppose a firm requires certain amount of investment at the end of first year. It will raise an amount equal to amount of investment I minus earnings plus dividend, where N is equal to number of shares outstanding in the beginning of the year and D1 is the dividend per share at the end of first year. To raise this amount, the firms will issue M shares at P1. have put their views as follows. According to MM, P is equal to D1 plus P1 upon 1 plus K, where P is equal to value of the share in the beginning of the year. It is value of the share in the beginning of the year. Suppose you invest P in the beginning of the year. At the year end, it will grow to D1 plus P1. If you invest P rupees in the beginning of the year, it will grow to D1 plus P1 at the end of the year. And what is the difference between this and this amount? This amount and this amount? The difference between this amount and this amount will be only on account of normal rate of return. If normal rate of return is 10%, if normal rate of return is 10%, if this is 100, this will be 110. Suppose normal rate of return is 15%. If normal rate of return is 15%, then if this is 100, this will be 115. So this is the amount that we invested in the beginning of the year. This is the amount that has grown at the end of the year. Difference between the two is normal rate of return. So if we discount this year end cash flow by normal rate of return, we get amount in the beginning of the year. The difference between this amount and this amount, difference between P and D1 plus P1 is on account of normal rate of return. So if we discount this amount by normal rate of return, the two sides are equal, where K is equal to cost of equity capital. With reference to dividend policy, it is also referred as capitalization rate, rate of capitalization, discount rate. Multiplying both the sides by n, where n represents number of shares in the beginning of the year. So this side becomes NP, this becomes ND1, this becomes NP1. Where NPV is equal to value of all shares in the beginning of the year, it is the value of the business in the beginning of the year. We add MP1 to the right hand side and we also subtract MP1 from the right hand side. NP is equal to ND1 plus NP1. In this we have added and subtracted the same amount. We have put the value of this MP1. What is MP1? M means number of shares to be issued. MM assume that firms are always in need of funds. They always keep on raising the funds. So MM assume this firm shall be issuing M shares at the rate of P1. What is P1? X dividend price of the share. So MP1 represents amount that we shall raise. Amount that we shall raise from the market, and amount that we shall raise from the market will be equal to our investment budget, budgeted investment, that is amount required for investment, minus E plus ND1. That is amount raised from the market will be, amount raised from the market will be I minus retained earning. Amount raised from the market will be investment required minus retained earning. So this is our ND1 plus MP1, we added MP1, we subtracted MP1, divided by 1 plus KE, we put the value of this MP1. This is the minus sign and this is the value of MP1. MP1 is equal to investment required minus retained earning. And retained earning is earning minus total dividend. Solving the equation, we find that ND1 to ND will cancel. We are left with this. As dividend is absent in the last version of the equation, MM conclude that dividend does not affect market price of the share. Since dividend is absent in the final equation, MM conclude that dividend does not affect the market price of the share. The theory, that is MM theory of dividend irrelevance, it is not considered to be realistic because of its unrealistic assumptions. Question number 10.1. Please refer to the chapter Dividend Policy of the textbook. Important points of the question. KE is 10%. Issued share capital 1 lakh shares. Current price 100 rupees. We have to find market price at year end. If dividend of rupees 6 is paid, what if not paid? KE is 10%. We have 1 lakh shares. Current market price 100. Current market price at the end of the year we have to find if dividend of rupees 6 is there and if no dividend is there. Current market price of the share is 100. K is 10%. Friends, if I invest rupees 100 today, at the year end, my wealth will be 110 because K is 10%. Normal rate of return is 10%. Normally shareholder will expect 10%. And in case of perfect competition, only normal return can be earned. So, if current market price is 100, wealth of the shareholder at the year end will be 110. If 6 rupees will be paid as dividend, he shall have 6 rupees cash in hand and his share will be worth rupees 104. And if no dividend, he will have nothing as cash in hand, but his share will be worth rupees 110. Current market price of share is rupees 100. Current market price of the share is rupees 100. KE is 10%. It means shareholders expect 10% return. It means normal rate of return is 10%. During perfect competition, only normal rate of return can be earned. So if today we make an investment of 100 rupees, at the year end, this will be worth 110. In perfect competition, that is the assumption of MM. If we invest 100 rupees, it will grow by normal rate of return. So if today if it is 100, at the year end the wealth will be 110. In this case, we will have 6 rupees in cash we will have 6 rupees cash in hand. The shareholder will have 6 rupees cash in hand and his share will be worth rupees 104. In this case, nothing cash in hand, but share will be worth rupees 110. So in both cases, his wealth is the same. Net income 10 lakh rupees. Investment required 20 lakh rupees. Number of shares to be issued if dividend of 6 rupees per share is being paid. This is the question mark. We have to find the number of shares to be issued if dividend of rupees 6 per share is paid. We come to first part of the question. According to P or P0, I mean price in the beginning of the year, is equal to D1, dividend per share at the end of the year, X dividend price at the end of the year. So the sum will become cum dividend price at the end of the year. This is wealth in the beginning of the year. This is wealth at the end of the year. The two differ because of normal rate. So if we discount the year end wealth with the normal rate, it will be equal to 0 period wealth. Now, two situations are there. No dividend is being paid. This is the wealth in the beginning of the year. Dividend is 0. P1 we have to find. This is 1 plus KE. P1 is equal to 110. Normal rate of return is 10%. No dividend is being paid. There is no cash in the hands of the shareholder. So at the end of the year, the share will be worth rupees 110. If dividend of rupees 6 per share is being paid, then this 100 rupees will be equal to 6 rupees dividend plus P1 divided by 1 plus KE. So P1 is equal to 104. That is, our share value will be 104. According to both of these figures represent same market price. Because according to my market price we mean cum dividend price. Here there is no dividend. So price is 110 and here there is dividend of 6 in cash and share is worth 104. So your cum dividend wealth is 110. Your cum dividend wealth is 110. Your wealth is, there is no dividend. Your wealth is 110. Here also your wealth is 110. You have got 6 rupees in cash. You have got 6 rupees as cash in hand. And 104 is the price of the share. So your wealth is 110 in this case. Your wealth is 110 in this case. Number of shares. Let number of shares is equal to M. This is the total investment required. This is our retained earning. This is earning. This is dividend. This is total earning. This is total dividend. This is total earning. This is total dividend. Earning minus dividend is equal to retained earning. This is our retained earning. This is the investment required minus retained earning. We require this much amount and we shall raise the shares at the rate of P1. We require rupees 20 lakh. Our earning 10 lakh. Dividend 6 lakh. So retained earning is 4 lakh. We require 20 lakh. Retained earning is 4 lakh. It means we shall be raising 16 lakh rupees. We shall be issuing the shares at 104. It means we shall be issuing 15385 shares. Why are we issuing shares at 104? Because This is X dividend price at the end of the year. Allottees of these shares won't receive any share in the dividend that is just now being paid. Allottees of these shares won't share last year's dividend. So they will pay only X dividend price of the share. So this is the X dividend market price of the share. So we will issue the share at 104 only.